Good afternoon, everyone. Welcome to class 4 of the market design segment of economic engineering. This will be our final segment, and we've got a lot of material to cover. We won't be able to cover everything that's in the slide deck. I've shortened it to things that I think we will be able to cover. And things that we do not cover, if you take the sequel course, Auctions and Market Design, they will all be covered in that course. So when we talk about applications. So let's begin where we left off, which is the looking at auctioning many similar items, in particular a divisible good, and the various auction forms. And I'm going to get a little pointer here. Good. So we were talking about the pay its bid auction, and they're basically the extensions of the 4 standard auctions. English, Dutch, the dynamic versions, first price, second price, have these natural extensions to divisible goods. And one of the most commonly used is the pay its bid auction. In all the standard forms, the auctioneer collects the demand curves from each market participant, and this is typically done either with step functions, so piecewise constant demand, or with piecewise linear demand. And both work very well. If the product is not lumpy but can be made nearly continuous, then the piecewise linear approach is preferred. But in all these, what the auctioneer does is draw the aggregate demand curve and cross it with the supply curve, which in this case is vertical, but it doesn't need to be. We find the clearing price, and then the bidders pay. These are the winners, everybody that's above the clearing price. These are the losers, and all the winners pay along their segment of the demand curve. So that's the pay its bid auction. Very simple. And then the uniform price auction, exact same thing. The auctioneer takes the aggregate demand curve, crosses with supply, finds the clearing price. But this time, and actually that splits the group into the winners up here and the losers down here. And in this case, the winners all pay the clearing price. That's why it's called the uniform price auction. And then the extension of the second price auction is the Vickery auction. And in the Vickery auction, we actually need to change the picture a little bit. We have to look at the individual demand rather than the aggregate demand. And we need to do that because we're going to be crossing to find the clearing price. You can find the clearing price the same way, where the aggregate demand curve crosses the supply curve. But in order to determine the pricing, we need to cross the individual demand curve with what's called the residual supply curve, which is the supply curve that we had before, minus the demands of all the others. And the residual supply curve is very important because when thinking about strategy in the auction, bidder I here is thinking how to perhaps adjust their bid, their demand curve, and the price impact that they have is going to be based upon what the residual supply looks like. Total supply minus the bids of the others. And so this actually is a very helpful way to look at the auction, regardless of the auction form. because it's more helpful with respect to thinking about the incentives. But what we do in the Vickrey auction is, rather than pay as bid, which would be along here, or uniform price, which would be the clearing price, we instead, the bidders pay along the residual demand curve. So that last little bit that the bidder wins, they pay the clearing price, but for all the incremental units, they pay along this residual supply curve. And the reason they do that is that's what induces the incentives to bid your true demand curve. You're in this case, you're bidding the opportunity costs of your winnings. And that opportunity cost is what's giving the right incentives. So just like the second price auction, truth is a dominant strategy. The same thing is the case here with the Vickrey pricing. Okay, let's give, it actually would be helpful to have a discrete example for the Vickrey pricing, which is the only complicated pricing. Pay as bid and uniform price, very straightforward. So here's an example where I've got 3 bidders, A, B, and C, and they each have demand curve, and the demand curve is downward sloping, as we typically have in economics. There's 3 items, and the demand curve, of course, shows the marginal value for each of the items. So the first item is worth 10 to bidder A, the second item is worth 6, the third item is worth 3, and similarly for bidder B and bidder C. And so now in the Vickrey auction, we need to do 2 things. First, we need to determine who wins what, or in this case, how many, and then we need to do the pricing. So the first thing, who wins what, is super easy. We just award the goods efficiently. The Vickrey auction is always efficient. So figuring out Vickrey is a piece of cake in terms of the allocation. So we just, and in this case, where we've got this table of marginal values for each of the bidders, then we just pick out we've got 3 items. We pick out the 3 biggest numbers. So that would be 10, 8, and 7. And I see that there's actually a little issue here, in that these are supposed to be behind, but somehow when it converted this file, it messed up the animation. So sorry, I've now hidden the prices, but they were, so let's go back. 10, 8, and 7. Okay, the 3 biggest numbers. So now we're going to do the pricing, and just remember that these are the 3 that won. So the pricing, we have to figure out how much bidder A pays and how much bidder for the single item that they won, and how much B pays for the 2 items. So the way to think about it is you pay the social opportunity cost of the items won. So when bidder A wins this item, that's actually preventing somebody else from winning. So what you do is you think about, well, what the opportunity cost is what bidder A's winning that item cost bidder B and C, the rest of society. And so we just look at bidder B and C and look for the next biggest number. Now we already awarded bidder B 2 items, so we can't, so those are gone. But now, because that's the award, but now we look at the next highest, which in this case is going to be 5. And so bidder A is going to pay 5 for that item. Now it's, we need to figure out how much B pays. And B is a little bit more difficult because he's got 2 items awarded to him, but we do the exact same thing. We figure out what the opportunity cost is of B's winning. And so we just ignore bidder B's values and instead look at bidder A and bidder C. And if B wasn't to win these 2, well, the first one would go to A, which has a value of 6. And so bidder B pays 6 for that first item, and then the second item goes to C, and bidder B pays 4. So that is the Vickrey pricing. And you can see the Vickrey pricing is not uniform price, it's not pay as bid, it is this social opportunity cost pricing. And it is, the pricing is specific to each individual, and that's one of its downsides. But the virtue is that truth is a dominant strategy, just like in the second price auction. So that's the extension. When we in the picture with a continuum of goods, the divisible good, fully divisible good, then it's just paying along the residual supply curve is the equivalent notion of opportunity cost, which if you can think about it and reason that that's going to be the case. So here are the 3 pricing rules together: pay as bid, uniform price, and Vickrey. And if you were very naive, you would think, well, okay, if I'm interested in revenues, I know exactly what I want to do. I want to do pay as bid pricing, because that's going to give me this whole area here. And for revenues, and that's much better than what the uniform price auction gives me, this rectangle, and much better than Vickrey, which is this area here. So that's the naive interpretation, but in fact, that's completely wrong, because the pricing rule impacts bidding behavior, and it impacts bidding behavior quite a bit. So in fact, we can't make any claim like that when we look at equilibrium behavior. And indeed, we can come up with examples that show that there's instances where pay as bid does the best, where pay as bid does the worst, where uniform price does the best, where uniform price does the worst, where Vickrey does the best, where Vickrey does the worst. So there's basically all orderings are possible. So now let's just think intuitively about strategy. So what are the optimal bids by the particular payment rule? And so the first thing, so here I've just drawn the true demand for bidder I, and the easiest one to do in terms of optimal strategy is Vickrey. It's going to be optimal to bid your true demand. So that's what Vickrey, that's the bid for Vickrey. And now in both the uniform price and the pay as bid, we're going to have an incentive to deviate from our true demand. And in particular, since we're buyers, we're going to be shading our bid from our true demand. And we shade the bid in quite different ways in pay as bid and uniform price. So first, let's think of uniform price. So what we want to do is take our price impact into account. And as we win more and more quantity, so where we move farther and farther to the right, my incentive to shade my bid increases. And the reason for that is that I'm winning more and more quantity, and every euro I save by shading my bid, I'm going to enjoy on the larger quantity. So if I'm winning just a single item, I don't care very much about the price impact, but if when winning 100 items, then that dollar saved is worth 100 euros rather than a single euro. So that's why I want to shade more and more, and as I bid for larger quantity. But right up here where I'm winning just an infinitesimal amount, I have no incentive to shade whatsoever. So I bid the truth at a quantity of 0, and then shade my bid more and more and more as I bid for additional quantity. So that's the uniform price auction. And you can see, because of the shading, it's now unclear whether Vickery or uniform price is going to generate more revenue. Now, pay as bid, the incentives are further different. In pay as bid, I like to think of the pay as bid auction as guess the clearing price, because what you want to do is estimate what the clearing price is going to be, and then bid as close to the clearing price as possible for the quantity up to your true demand. So if you knew exactly what the clearing price was, you would just bid a completely flat demand curve at the clearing price until it hit your your true demand. So again, substantial shading, but notice just the difference in the way the shading occurs. In pay as bid, I shade much more for those early units, and then much less for the later units, okay, when I'm winning a large quantity. And in general, the pay as bid is going to be a very flat bid curve relative to uniform price. So uniform price is very steep, pay as bid is very flat. And the reason is, on pay as bid, I've got an incentive to bid as close to the clearing price as I can. The clearing price is uncertain to me, typically. And so there's sort of a range of possible clearing prices. And I want to make sure when my value is super high that I'm definitely going to be winning. So I bid above what I think the expected clearing price is. But then once we get out here, I want to bid likely below the expected clearing price because I'm very happy losing these units, because the profit I'm making from these last units is effectively 0. Okay, so that's intuitively what's going on. Now, in practice, we have to do a little bit more work for all but the Vickery. The Vickery, we don't have to do any work. We just bid our true value. But for uniform price, I've got to do some math to find out what the optimal shading is. And the same thing with pay as bid. So both of those are going to be more complicated for me to calculate. But just as we were able to find the equilibrium in the first price auction, through direct calculation, we can do the same thing with pay as bid and uniform price. Then there's the dynamic versions. So each of these can be implemented with a dynamic version. So the uniform price is the most common here, and we implement the uniform price with a clock auction. So an ascending clock auction, starting at a low price, we raise the price until supply and demand balance. We can also do the clock auction with Vickery pricing, as Larry Oswell has proposed. And so that works the same way. We just use a clock, and then once it becomes mathematically impossible for a bidder not to win quantity, then they'll basically start paying along the residual supply curve. And That's the Vickrey, the same as the Vickrey pricing. Okay, so let's take a look at these. So here is our clock auction. The bidding starts way down here. We've got lots of excess demand, and then the auctioneer raises the price, and they continue to raise the price until supply and demand balance. Now, when we're conducting this ascending clock auction on the internet, the way that we do it is even when the goods are perfectly, well, it doesn't matter whether they're perfectly divisible or lumpy. But the way we do it is rather than do it in continuous time, we do it in discrete time. And that's because communication is much more reliable. Continuous time is a figment of a theorist imagination. It doesn't actually exist in the real world where we're using discrete computers for computation and communication. And so it really does make sense to do discrete rounds. But when we do discrete rounds, the state of the art is to always ask, so you might have an opening price, let's say right here, where you initially ask everybody what quantity they want, but then all subsequent rounds, you have an interval of prices, and you're asking the bidder to express the quantity for all prices in that interval. And that's the way we do it, so that when we get to the end here, we can exactly balance supply and demand at the end. That's the modern implementation of an ascending clock. With Vickrey prices, we do the same thing. The only thing is we're calculating the residual supply curve to, so right at this point, nobody has to win, but when as we go along, we get to this point right here, where then all of a sudden, this bidder I has to start winning, and now they start paying along the residual supply curve. But it's just a settlement issue. And so it's, essentially the same thing. But in the final price settlement, we essentially give these quantity discounts for the larger bidders that are winning more, and that's bribing them to bid truthfully, effectively. So lots of other ways we could do the simultaneous ascending auction that the FCC does. And now initially they did it as the simultaneous multiple round auction, but now they use a simultaneous clock auction, as I described. We also could auction things in sequence, as is done for fish and flowers, and is done in the auction. And then that's the Dutch auction, and the English auction's done in the auction houses. And we could do the optimal auction for focused on revenue maximization, and I'll talk about that in a moment. There's been the recent work looking at the optimal auction with multiple divisible goods. But this was the early work by Maskin Riley. In looking at these different auction forms, two of the main issues that the economists look at are efficiency and revenue maximization. There are certainly other issues that are important, such as transparency, transparency, simplicity, and fairness, as I mentioned before, but really the economists have focused primarily on efficiency and revenue maximization. Sometimes efficiency is the right objective. So if I'm advising a government in a communications auction, a spectrum auction, then I tend to encourage them to focus on efficiency rather than revenues. The efficient auction will raise lots of revenues, and it has the advantage that you're making the best use of the spectrum, and given all the complementary complementaries with the rest of the economy, it's actually very nice to put that spectrum to its best use. Other times, revenue maximization is very important. So for example, the Treasury, if I'm advising the Treasury on how they should do their debt auctions, then I would recommend that they follow cost minimization. They want to sell the debt at least cost, which is equivalent to the revenue maximization objective. So both objectives are important. I personally, in my market design work, I tend to focus more on efficiency than revenues because basically because an efficient auction encourages participation and is more apt to, in the big grand scheme of thing, where the auctions are repeated, where participation is voluntary, the efficient auctions are actually going to, in my mind, perform better in the long run than a narrow focus on revenue maximization. So efficiency, it's quite clear that the uniform price auction is going to have, will be inefficient because of demand reduction, which I'll emphasize again in a moment. The pay as bid is going to be inefficient because of the differential bid shading that the bidders engage in. The Vickrey pricing will be efficient in the private value setting. So that's very nice. It's strategically simple, dominant strategy to bid true value. And but once we expand the model outside of private values, it's no longer going to be efficient necessarily. And the dynamic implementation of Vickrey also is going to perform perfectly with private values. The dynamic implementation has the further advantage in that in at least very simple environments, you can still retain efficiency with affiliated information. So that's an advantage of the dynamic implementation. And in fact, the dynamic implementation, whether it's Vickrey pricing or uniform pricing, is generally preferred because the strategies tend to be simpler. It allows the parties to have price discovery, so reducing the winner's curse. But even more importantly, when we're auctioning many things, the price and outcome discovery that's afforded by a good dynamic auction enables the bidders to better piece together a portfolio of products that is more desirable. So that price discovery is not just about winner's curse, it's also about identifying what package of things you should win. And that's going to be especially important. Well, it's always important, whether the goods are substitutes or complements or both. So let me start with the result for the uniform price auction, which is that in any equilibrium of the uniform price auction with positive probability, objects will be won by bidders other than those with the highest values. So the uniform price auction is always inefficient. And it's because the bidders take their price impact into account. They exercise a little bit of market power, and that creates a distortion, which introduces an inefficiency. So the winning bidder influences the price with positive probability. In general, there's one or two knife edge cases where that's not true, and then we can get efficiency. But in general, the winning bidder will influence the price with positive probability. That creates the incentive to shade the bid. The incentive to shade increases with additional units, and it's that differential shading that is going to imply an inefficiency. So we can see that picture here, and we actually know exactly how this is going to work because the incentive to shade varies based on whether you're a large bidder or small bidder. So in this picture, both bidders, it looks like they're essentially doing the same thing, but the impact of doing essentially the same thing, taking the price impact into account, results in much more absolute shading by the larger bidder. And as a result, what happens is the larger bidder wins too little and the smaller bidder wins too much. And so if we look at this, in fact, given this demand curve for the large bidder and the demand curve for the bidder two, the efficient outcome would actually be, so if we want to award to the highest marginal value, well, notice, right, this is where the small bidder starts demanding. And at that point on the demand curve of the large bidder would be consuming more than Q1 plus Q2, the total supply that's available. So efficiency dictates, in this case, the large bidder should win everything. But instead, what the large bidder does is substantially shade her bid. And as a result, this large bidder is going to make room for the smaller rival. And that's the source of inefficiency in the uniform price auction. Now, let me say one very important thing about this. So you might say, oh, well, uniform price auctions are bad. We should have Vickery pricing. And that might be a short run, sort of one-shot auction. You might want to do that. But in repeated auction contexts, which would be the typical case, we do the treasury auctions again and again, we do spectrum auctions again and again, all commodity markets again and again, electricity and so on. So in fact, it's important to think about what the sort of longer term dynamics of this exercise of market power are. And when you think about it that way, you can see that the uniform price auction actually has this very desirable feature in that when a bidder has market power, the exercise of market power is giving an opportunity to the smaller participants. So that's a very pro-competitive response, because typically competition comes into a market from the smaller guys. And so this exercise of market power is creating an opportunity for competition. And that's the main reason why I tend to favor the uniform price auction in practical settings. So for example, in electricity markets. And I don't recommend either pay its bid or uniform price. Okay, so it should be clear that the Vickery auction, well, actually, this is maybe a little bit subtle, but once we step outside of private values and we've got some common value element, then we can extend our thinking about the winner's curse. So the winner's curse in a single item, you'll recall, is winning is bad news about value. And I need to, in order to avoid the winner's curse, I need to condition on the bad news that winning conveys. The winner's curse in the multi-unit auction is generalizes. But how does it generalize? Well, it generalizes in this way. Winning more is worse news about value. So the more you win, the more biased your estimates are, and you need to shade more aggressively. So the larger quantity you bid for, the lower you want to bid. And that differential shading creates an inefficiency in the Vickery auction. So Vickery pricing is not going to be efficient in the richer model when we step outside of private values. Okay, let's turn to revenues. What about seller revenues? It's a lot more complicated than this naive view that just looks at the area under these curves. And we will see that. Let's actually do an example first though. And so in this example, we have in which you'll all be bidding, and but we're only going to have 2 bidders. So last exercise we did, we had 16 bidders, and because there were 16 of you and you're all competing against each other. In this case, we have just 2 bidders, because there's just 2 items, and I'm just going to have 2 bidders for these 2 identical items. So, and one bidder I'll call left, and one bidder I'll call L, and the other R for right. Now, let's see. So I'm going to actually split you into a group. So let's go down to, so just alphabetical by first name on the participants list. Johanna and through Tim will be our bidders. Okay, so remember this. Johanna, if your last name is Johanna or something that comes alphabetically after Johanna, you're an R bidder, and all the others in the class are L bidders. Okay, and the way to think about this is I'm going to pair one L with one R. And so your bid as an L is going to be competing with one R. So hopefully that's clear. Let's keep it super simple and not have any private information. So I'll just tell you what your values are. So if you're an L bidder, okay, that's all those early in the alphabet, you have a value of 100 for the first item, and you've got the same value of 100 for the second item. So your marginal value is 100. You've got a flat, what we call a flat demand, marginal value of 100. And so if you win one, you get 100. If you win both of them, you get 200. Now R, those in the end of the alphabet, Johanna on down, you have a value of 90 for one, and the second item is worth 90 as well. So a total value of 180 if you win both. So again, a flat marginal value. So if you so your demand curve for L would be 100, 100 for first and second item, and 90, 90 for R. Now we're going to auction first using the uniform price auction, and then we'll do an ascending clock. And I've never done this using chat, so this is going to be a science experiment. But what you want to do is figure out what your strategy is. So, so actually, and you actually don't have to, you have to tell me what type of bidder you are. So let's see. So I'm Peter, so I would be in the second half if I was to bid. So I would enter R, and then I need to submit 2 numbers. So R is my bidder, the role that I'm playing. And so as R, I've got a value of 90 and 90, uniform price auction. So let me say I'll bid, I don't know, so I'm not going to solve a lot of differential equations here. Let's say I do something like this. Okay, so now you can see in the chat room, my bid of 85, for the first item I win and 85 for the second item I win. Okay, now what you want to do is change that to everyone, change it to me, okay, which I can't do because I can't send a message to myself. But you changed it to Peter, and then send me your bid in the uniform price auction. So, but it should be just like this, 2 numbers. So just, well, L or R based on your role, and then the 2 numbers. And so you can go ahead and send those to me. Okay, so I'm going to set those aside for right now, because now what I want to do is ascending clock. But when I do the ascending clock, not everybody can participate. I just need 2 volunteers. So one L bidder and one R bidder, and just click yes if you are going to volunteer. This is fun. Don't worry. And I'll just, but we're going to do an ascending clock auction. So any volunteer? No, no one wants to volunteer. Yes. Okay. Okay. So Sebastian's volunteered. And one more. So Sebastian, you're going to be our bidder. Another volunteer from earlier in the alphabet. Okay, Isabel. Great. Okay, so we have 2 volunteers. So normally what I do is I just have you indicate the quantity that you want in the ascending clock auction. So I start at a price of 0 and you want 2 items typically. And then I raise the price. And what I do is I keep track of the number of fingers that are shown. And so then as soon as we get to a point where you want to reduce your quantity, then one of your fingers comes down. But notice here, we still have a demand of 3. I've got 2 available, so we still have excess demand. So the clock keeps going up. So the clock's going to keep going up until we're just down to 2 fingers up. Okay, that's the way I do it in the classroom. But I can't do it in the classroom this way because, I mean, we could if you turned your cameras on, but instead, if you don't want to turn your cameras on, that's fine. You can instead just indicate your bid, Sebastian and Isabel, or maybe green for 2, red for 1. Okay, we can do that. That's a better idea. Henry's got a good idea. Okay, so green will be for 2. Sebastian, just so that if you could click yes. Okay, there. Okay, okay, good. Okay, so actually, okay, so now we've got Sebastian and Isabel both wanting 2. So they've got 2 fingers up. That's what yes means. And then when they click no, that's going to be 1 unit. And then when they unclick no, that's going to be 0. Okay, so I'm starting at a price of 0. Isabel and Sebastian are both bidding for 2. Sebastian is bidder R, Isabel is bidder L. Okay, it's worth 100 a unit for Isabel, 90 a unit for Sebastian. Okay, so so hopefully everybody's clear. Yes means 2, no means 1, and no means 0. Okay, so the clock auction is now ascending. So we started at 0, both are on green, that's 2. So we've got a demand of 4, $10, $20, $30, $40, $50, $60, $70, $80, $85, $89, 90. Okay, now we're down to 3. 90, Sebastian dropped out. And so so that means Isabel, you won, and you won both items, and Isabel made money. So $40. See, I told you this was fun. Not only was fun, it's profitable. You guys were really scared after what happened with the jar of coins, but in fact, this one you made money. That's great. So what's the message here, though? The message is that, in fact, the strategies were not actually consistent with equilibrium play. In fact, something else should have happened. And so let me now explain why there actually is a unique way to play this ascending clock auction. And here's the reasoning. First of all, Sebastian, with having a value of 90, you're certainly at a disadvantage. Isabel's got a value of 100, and you both know that. But now the question is, so one thing that Isabel was probably thinking, well, I'll just bid for 2, and then when I'll be able to push Sebastian aside, because his value is 90. So he's going to drop out at 90, and then I'll win 2 items at a price of 90 and make $40, which is exactly what happened. So that sounds like a good strategy, but there's a better strategy. And the better strategy is to recognize that in order to win the 2 items, you have to bid the price up to at least 90, because there's no way Sebastian's going to drop out before 90, because otherwise he gets nothing, and he might as well hang in there until 90. But what if Sebastian bids for 1 at a low price? So actually now, let me think in terms of Sebastian having the disadvantaged position, having a value of 90. Okay, so that was in terms of Isabel, the L bidder. But for Sebastian, it is a really nasty situation, because let's see. So you start out bidding for 2. What do you have to do in order to win 2? Well, you have to push Isabel aside. And Isabel, if you're bidding for 2, Isabel would have to win 0, which means you've got to push the price above 100 per unit, in which case you're going to lose money. So there's no way for you to win 2 items. Well, let's think about what would happen if then you bid for 1 item. What if at a price of 0, you bid for 1 item? Well, then the circumstance for Isabel, the L bidder, changes quite a bit. Because if at a price of 0, you're bidding for 1 item, then Isabel knows, well, I can push that price up to 90 and win both items for a total profit. I said a profit of 40, but I meant a profit of 20, because it's 180 and the value is 200. So it's a profit of 20. But I can do even better. So Isabel can do even better. She's bidding for 2. She knows she has to push the price at least to 90 in order to win both. And that's a profit of 20. But if now with bidder R bidding for 1 item, she can reduce demand to 1 at a price of 0. And guess what? The auction ends at a price of 0. And then Isabel makes what? 100 rather than 20. So it does much, much better. And that actually is the unique way to play this ascending clock auction. And then the reasoning was essentially that there's no way that R could win 2. So R bids for 1, but if R is bidding for 1, then L has an incentive to unilaterally end the auction by dropping to 1 as well. So that's demand reduction, which is what we were just talking about in the uniform price auction. And it's so essentially the optimal bids, there's different things one can write down, but one version of the optimal bids would be for L to bid 100, 0, and for R to bid 90, 0. So 90 for the first and 0 for the second. That's the demand reduction. Now, interestingly, when I look at what you bid, no one did that. Everybody bid pretty much what I did. You've got a flat demand, you bid a flat demand. But in fact, your equilibrium, both parties would be better off if they engaged in the demand reduction. However, this is one of these nice knife edge cases where in the uniform price auction, if you think the other party is bidding a flat demand, then you might as well bid a flat demand too. So it's actually an equilibrium. Bidding 100, 100, 90, 90 is also an equilibrium in this case, but not in the ascending auction. That's not an equilibrium. And this is a very important and natural insight in any auction of multiple items that you want to take the price impact into account. And in fact, it is the dominant driver in, let's say, financial markets. So if you're participating in financial markets, that's everyone, even small participants, small traders, will take price impact into account, even when they're trading Google stock or some other very liquid security. Unless it's just a handful of shares, there's going to be a price impact, and you want to take the price impact into account. So it's a very important phenomenon. Good. And this, like the jar of coins, I do this exercise all the time, and it always ends this way. The bidders do not do the demand reduction that they should be doing. It doesn't come, it's a bit more intuitive than the winner's curse, but it's still, the bidders need some training and experience in order to make sure that they're engaging in demand reduction in the right way. And I certainly found this in spectrum auctions, where one of the first things I do is explain demand reduction to the participants, because it's effectively a uniform pricing that's used in the simultaneous ascending clock auctions. And so they need to understand their price impact and recognize that by reducing demand, they can actually, in some cases, win more quantity. And that's not very intuitive, but it is once you recognize that bidders in real auctions have budgets, a limited amount of resources that they can bring to the table. And so if prices get up too high, then a bidder with a budget is forced to buy less. And so you can easily write down cases where engaging in demand reduction has the implication in the market overall of actually allowing you to win more, because it's keeping overall prices down. So very important phenomenon. Okay, So this is an instance where the uniform price may perform poorly. It's an instance where we had weak competition. I should say one more thing about this, and that is one thing that the seller could have done to protect themselves against this possibility of limited competition is to set a reserve price. So if they set a reserve price that was sufficiently high, let's say if the reserve price was above $80, then the incentive for demand reduction would go away. Then Isabel would indeed want to bid for 2 and push R aside because she'd make more that way than just letting it end at 80. Winning 1 unit at 80, she'd rather win both at 90. So there is that protection, and that's going to be a very natural protection when you have the possibility of limited competition. When we look at the Vickrey, there's no incentive for demand reduction, so Vickrey actually performs better in this case, although, as I said, there's 2 equilibria in the uniform price auction, and in the example we just did, the high price equilibrium performs better than Vickrey. So, lots of things can happen. And the same thing, and this also illustrates that when you have limited competition and you have this dynamic process, the dynamic process can actually facilitate the low revenue equilibrium. By revealing information about excess demand, it may make it easier for the parties to exercise market power. But essentially, overall, the incentive to exercise market power in a uniform price auction, whether it's implemented dynamically or in a sealed bid, is fundamentally the same. It's just in the dynamic process, if you're not careful, if you reveal too much information, you may give the participants a way to facilitate coordinating on lower prices. So can we say anything more? Well, one thing we can say is the efficient auctions tend to yield high revenues. And when we have flat demands independently drawn from the same regular distribution, the seller's revenue is maximized by awarding goods to those with the highest values. So that's a very nice result. And that result is, doesn't mean we won't have inefficiency, because in fact, to maximize revenues, in this case of symmetry with flat demands, what the seller wants to do is withhold some of the goods. So not sell everything. And that's the way they improve revenues. They don't improve revenues by misassigning the good. When we have downward sloping demand, then actually we can say very little. Here's one theorem which we're able to prove with the mechanism design techniques from last class. But it's very special. It says that so now we've got a linear demand, and if the intercept is drawn independently from the same distribution, the seller's revenues are maximized by awarding good to those with the highest values if there's a constant hazard rate. And otherwise, we want to shift quantity towards high demanders if there's an increasing hazard rate. And when we look at, first of all, constant hazard rate, that's very special. The only probability distribution that has a constant hazard rate is the exponential distribution. So it's very special. But at least there's one instance where awarding the good to the guys with the highest values with downward sloping demand is consistent with revenue maximization. But in other instances, other distributions like the uniform distribution, okay, the uniform distribution, that has an increasing hazard rate, right? Because the closer you get to the end of the support, the hazard is going to infinity. It goes, it's increasing. And so this result says that you should shift quantity towards the high demanders if there's an increasing hazard rate, as there is with the uniform distribution. Okay, but what does the uniform price auction do? It shifts quantity towards low demanders. Remember the example, the large bidder makes room for the smaller rival. So that's shifting, the smaller rival is winning too much in a uniform price auction. So that's a strong suggestion that the uniform price auction probably isn't maximizing revenues. But as I said, that's not such a terrible thing, because it's, at the very least, it's that exercise of market power is pro-competitive. It's encouraging entry in the current auction and future auctions. Okay, and that's something that's not addressed by this theory. So, and that's the other advantages: encouraging participation by the small bidders, stimulating competition, and then post-auction competition is higher too. So for example, if I'm procuring resources from suppliers, I might want to make sure that I've got multiple suppliers that win, so that the next time we have an auction, there will be multiple parties that can that'll compete in my procurement auction. Okay, so let's talk a bit. Another application of this is to electricity markets. And I just want to show a few pictures that illustrate this phenomenon of bidding in a uniform price auction. And in this case, the generators bidding in the electricity markets are suppliers. And so they're going to offer a cost curve, a supply schedule, and that supply schedule is going to be increasing. And they are going to have an incentive to overstate their costs. Okay, so this is the reverse auction form. So things are reversed a little bit, which is one more reason to show this. And my broad message here is that essentially all market power is an issue. And it's an issue sort of irrespective of what the auction form is. And regardless of what you do to try to mitigate market power, it's always going to be an issue that the market designer should be concerned about and try to mitigate. My view is that the market design should be designed recognizing that the market participants are going to act in their interest. They're going to, my goal is, my job as a market designer is to establish the rules of market interaction so we get effective equilibrium outcomes. Now, and so this idea of generators bidding in a way to maximize profits, to me and most economists, should be very natural. It's a norm of behavior that should be expected and encouraged. But in the development of electricity markets, there was a tendency for, at least in the initial rules, for the regulator to step in and say, thou shalt not exercise market power. And that's, really problematic. You should, thou shalt bid your true costs. And that's very problematic because it's hard to verify what true costs are. In the context of electricity markets, it is possible to at least get a pretty good idea what somebody's costs are. And so what we do to mitigate market power in electricity markets is most of the time we let the bidders do whatever they want. And we're just presuming that they're going to bid to maximize profits. And we're going to hope that the auction is competitive enough that any exercise of market power is not such a big deal. And that turns out to be the case in our markets today. Most of the time, it's not an issue, but every now and again, there'll be a outage of some sort, transmission line will go down or whatever, and local market power will appear. And what the market rules have in place in that instance is that when local market power does rise, that can be fairly extreme. So you could effectively bid, all the way up to the price cap and be accepted if you're in a situation where the system operator just has to have you in order to satisfy constraints. So what we do is we have automatic mitigation that steps in and fixes this temporary problem. So in some of the markets, like PJM, there's two bids. There's your bid, which is what you're entering every day, and you get to enter whatever you want. And then there's your cost bid, and your cost bid is an estimate of cost that the market monitor makes. And what happens is there's a market power test that's done continuously. And so every 5-minute interval, it's determined whether or not you have excessive market power. And when you do, the system operator automatically substitutes your cost-based bid for your bid. And that's how market power is mitigated automatically in real time in the rare instances where it appears. In other markets, such as Texas, there's a different approach, which is equally effective. It's called the Texas two-step, which is a particular dance that you've probably never heard of. But essentially what it is this two-step process where the system operator announces the binding transmission constraints that create local market power. And what then happens is the system operator runs the optimization that determines the prices and allocation that maximizes social welfare. But then, and that determines the allocation, but then to determine the prices in those places where there's local market power, it reruns the problem with the constraints that created the local market power removed. And so that removes what caused those local prices to be excessively high. And then those prices are substituted. But again, the markets are very competitive, and this automatic mitigation is used very infrequently. And there might be many instances of using it, but its overall impact on prices is extremely small. That's how I know that the markets are very competitive. So that's a good thing. And that's the sort of thing that we can do to, and this is, it's very relevant for Europe, because in the United States, we have what are called nodal markets rather than a single uniform price for the entire market. We've got a price potentially at every node in the market. And there's, in Texas, there's 12,000 nodes, something like that. So there's the potential for 12,000 different prices. And people get really scared about that in Europe, where you've got one German price for electricity. And the reality is the Texas system is actually much better than what happens in Germany. In Texas, if you look at our prices, our real-time prices, there is almost all the time a uniform price for Texas. And the only time there's price differences across these nodes is when there's these binding transmission constraints that have to be addressed, and that causes some typically fairly minor price differences. The price differences can be very large, but that's exactly when the automatic mitigation steps in and makes sure that the market participants don't have very strong incentives to exercise local market power. So at the end of the day, we have prices that are, we nearly have a single Texas price, but in fact, there's 12,000 prices, and those prices respond immediately and effectively to uncertainties that happen in the grid. Whereas in Germany, they try to force this uniform price. And what that does when you have congestion, and Germany has pervasive and persistent congestion between north and south because the load is in the south, more load is in the south, and the wind is in the north. So as you're introducing all of these renewables, the wind from the north, you're bumping into these transmission constraints that they carry the electricity from north to south. And so the big problem then is that the market participants do not have the incentive to act based on the price that's presented. And so the the system operator then has to go to the generating units and say, look, we've got this binding constraint. We need you to do something differently than what you want to do. And so what we're going to do is we're going to pay these guys in the north to produce less, and we're going to pay these guys in the south more to produce more. And that's going to address the transmission constraint. Well, the problem with that is it creates horrendously bad incentives that are extremely costly to the German citizens. It's on the order now of let's see, I'm not sure I can remember the exact number, but it's many, many billions of euros every year. I think last year it was 5 billion, something like that. It's a lot of money, and it's very bad incentives. The market participants have terrible incentives about where to locate, and it's not a good approach. And at least in Germany, they have what's called cost-based redispatch, where the system operator figures out what the costs of the generators are, and then the compensation for this redispatch is based upon the actual cost. The folks in the European Commission in Belgium are now proposing market-based redispatch, which is basically the same thing, except for now you get to bid how much you want to be paid to be redispatched. And what that does is just magnify the terrible incentives from the original redispatch. And so it amplifies market power rather than reducing it. But it sounds nicer because it's market-based. So it's quite comical looking at this to see what's happening. And eventually Europe will move to nodal pricing, but the appetite, because it just makes so much sense and it works so well, but the appetite for doing this is incredibly low right now, which is quite sad because the course that Europe is on is unsustainable. And so it just is going to have to be fixed. That's why I can say, eventually it'll be nodal pricing, because it's going to be the only thing that'll work. And you can try all these other things, zonal, splitting Germany into 2 zones, north and south, and that'll work a little bit. It'll certainly work better, but it'll still have serious problems. And so, my view is that they just need to go to nodal pricing. So that was a little bit of a digression. So we were talking about bidding behavior in electricity markets, and here's the basic picture. They're all uniform price auction markets. And so you're facing this demand, and you this is the supply that's bid, and that determines the clearing price. And it's more complicated than that because there's lots of constraints. And in a nodal market, effectively what we're doing is maximizing social welfare, which is what this is doing in this very simple case. This is the efficient point that maximizes social welfare, the area underneath the demand curve and the area between the demand curve and the supply curve. Doing the same thing in the nodal markets, but we're just maximizing social welfare subject to all the constraints. And so those constraints will have shadow prices that will affect the pricing, and that's why you're getting the different pricing at the different nodes. But effectively, all that's doing is finding the supporting prices of competitive equilibrium. And it's quite an elegant, simple approach, extending the uniform price auction to many products with constraints and complex environments. Okay, well, the first thing that you want to do when you're thinking about bidding as a supplier is looking at your residual demand curve. And you do that by just taking the aggregate demand and subtracting the supply of the others. I'm sorry, the aggregate, yes, the aggregate demand and supplying subtracting the supply of the others to get the residual demand. And notice that when we do that, we still have, when we plot the supply firm I and the residual demand curve, we still have the exact same clearing price. Doesn't change the clearing price at all. It's just a different way of looking at the problem. But the reason it's useful is it's this residual demand curve that the supplier is going to be optimizing over when considering their price impact. Just the way it was the residual supply curve in a forward auction that a demand bidder is going to be optimizing to determine price impact. So here it is with the formulas for residual demand, and here's my supply curve as bid. And I say as bid because I don't have to bid the truth, my true marginal cost. This is what I'm going to be giving to the system operator as my as bid supply curve. And in all the electricity markets in the United States, these supply curves are specified as piecewise linear curves. You can also specify piecewise constant if you want, but most participants specifies piecewise linear, just as we have here. And there's the price. Now, what I want to do is figure out how I should bid. And in an instance where I'm facing a perfectly flat residual demand curve, then it's quite simple. I just bid my true marginal cost. And that's the best I can do. If I distort by bidding a little bit, let's say I exaggerate my cost, then I will be simply losing quantity. I won't be impacting the price. I'll just lose quantity from the efficient level. And so I'm worse off. But more typically, the residual demand curve is not going to be perfectly flat. It's going to be downward sloping. And as soon as it's downward sloping, then I want to exercise market power by bidding above my true marginal cost. And when I do this, you can see this is going to be the incremental gain. And here's the incremental loss. And you can see that the gain is much bigger than the loss. So I want to continue to impact price in a favorable direction until I get to something that looks like this. And so this is basically what the mathematics would tell me when I'm maximizing my profit and choosing how much to exaggerate my cost. The mathematics will then identify this point where the first order condition of that maximization is going to be equating the marginal gain and the marginal loss from this exaggeration of my cost. So that's the optimum in a picture rather than in the math. But the math's very straightforward, so I'll let you do that on your own. But just wanted to make some broad points. First, the flatter that residual demand curve is, the less I want to exaggerate. So as it becomes flatter and flatter, and in the limit, as you saw, when it's completely flat, I want to bid my true costs. So just as we had before, the exercise of market power is going to involve the large bidder making room for smaller rivals. And that's seen in this picture, but it's essentially the same. The smaller bidder is going to be facing a flatter demand curve, residual demand curve, and that's going to cause them to exaggerate less. However, and this is extremely important, so this is the most important slide in this set on electricity, and that is the impact of forward contracting. Because in the electricity markets, one of the things that makes them work so well is extensive forward contracting. So yes, we've got a day-ahead market. Yes, we have a real-time market, but most of the volume is actually transacted well before we even reach the day-ahead market. A lot's transacted in the day-ahead market, and then in the real-time market, which would be in Germany, they'll have the intraday market, and then there'll eventually be a balancing market, but the structure is a little bit different, but this outcome is the same, that there's lots of forward contracting, and the forward contracting does an enormous amount to mitigate the incentives to exercise market power. So here, just looking at this picture, this is the guy without a forward position, and here's marginal cost. This is what he would want to bid, something like this, without a forward position, taking his price impact into account by looking at the residual demand curve. But now, let's suppose he's got a forward contract. So he's already sold forward much of his quantity, and now he's just got a little adjustment that he's making. And in this case, he does actually want to sell a little bit more. But at the quantity of the forward sale, he is in a balanced position. He's neither buying nor selling. Sellers want to overstate, buyers want to understate. Somebody that's in a completely balanced position doesn't want to do either. They bid their true marginal cost. And then it goes upward from there once he turns into a seller. But down here, this guy with the forward sale at these lower quantities, he's actually a buyer to cover his forward sale. He's going to buy from the market. And so as a buyer, he's understating. So you can see this is the mitigation. The amount of mitigation is absolutely enormous. And if the position that the supplier is taking in the forward sale is moving them towards a more balanced position, then it's highly pro-competitive. And in fact, that's what it is, because that's what mitigates risk. Most of the time, there's been a few instances of abuse of market power where folks would go the wrong direction. Rather than move towards a more balanced position, they would do the opposite in order to inflate their incentive to exercise market power. But almost all the time, this is what the market participants do, and it's extremely helpful. And in fact, one form of market mitigation market power mitigation is to mandate forward sales. And some markets do that to some extent. So California now does that. So that's one approach. And when we talk about capacity markets, well-designed capacity markets also have a forward, essentially a forward obligation for shortage situations, and where the prices are going to be extremely high. And that's very nice because it mitigates market power in the instances where the markets are most apt to fail because of market power. So we won't have time to talk about that. Now, I wanted to generalize the revenue equivalence theorem that we had from before, and also talk a bit about how the optimal auction extends from what we had before. And so this actually is very nice because it's going to show you sort of exactly how much we can generalize and still keep things extremely simple. So we're going to be auctioning identical items. So a divisible good, let's say there's a quantity of 1 and there's n bidders. Bidder I can consume anywhere from 0 up to some maximum, but the maximum could be 1. So it could be no constraint whatsoever. We put that in because there's many markets where there is a constraint in how much any one bidder can win. And for example, treasuries, you can only win 35% of an issue. And so each of the bidders are going to have this quantity, and the vector of quantities are going to have to sum till something less than or equal to 1 to be feasible. They'll all be positive. And each bidder has a type, their private information. The types are drawn from some distribution, a different distribution for every bidder. So we don't have symmetry. We need to assume that the types are independent. But now here's the nice thing, the marginal value can be very general. So the marginal value can depend upon the full vector of types, everyone's private information, as it would say in a Comet value model, where we're all estimating how much oil is under the ground, and so everybody's information is contributing to what value is, and then this marginal value varies with quantity, and will be you'll see in a moment it'll be decreasing. So I'll downward sloping demand curve. So VI T comma QI is my marginal value curve, which is of course my demand curve. That's what a demand curve is, marginal value. The payoff that you get is just integrating under your marginal value curve minus your payment. So here we've got the quasi-linear utility. Its payoff is linear in money and the good. And that is our setup. So it's very general, but we did have to assume independence. That was the sort of the main thing that we had to assume, and quasi-linear utility. Independence, quasi-linear utility. That's going to be enough. We can have divisible goods, no problem. We can have private value, common value, somewhere between private and common value, no problem. But I do need to have the independent types, which is of course special, but anyway, it's going to bring us a lot. So I do need some conditions on marginal value, but they're all very natural. It needs my value is increasing in my type. So that just gives type some meaning. Weakly increasing in other people's types. So if there's no impact, then it's private value. Weekly increasing in type, again, that's just that the types are properly ordered and is very natural. Weekly decreasing in quantity, downward sloping demand curve, very, very natural. And then finally, one more, and this is more of a technical condition, value regularity, which says that if I consider two possible types for me and holding everything else fixed, but two possible types for me, then if I have a higher marginal value than bidder J, when I increase my type, I still have a higher value than J. So in particular, this is saying that my private information is more relevant to me than it is to you. That'd be one way of putting it. But that's also, something that's very helpful in making everything come out just beautifully. And I think it's very natural, that I should care more about my private information than you do. Now, if we have really huge asymmetries in information, I could certainly see that there might be some possibility. But if my information is really good and yours is really poor, then still it's going to be the case that when I have a higher type, I'm gonna value that higher type as well. So it's not, it's not clear maybe which way this should go, but this is very natural. Okay. So the next thing, and this is actually more a result than a definition, but it's a so in the single item case, if this was a single item, then my virtual valuation would just be this V minus 1 minus the distribution over the density, okay, the inverse hazard rate. And so what's new here is, and that virtual valuation, another, a better name for it is probably marginal revenue, because that virtual valuation is the marginal revenue that a bidder, that the seller gets by awarding the good to that type. And so the generalization of marginal revenue to this divisible good context is essentially the same as before, but now we've got this additional factor here, which represents how the marginal change, how marginal value changes with changes in type. And that's the only thing that we have to do to represent marginal value. Now, the next theorem is going to, the next revenue equivalence theorem is actually going to prove that indeed this is marginal revenue, that this is by allocating additional quantity to bidder I when the vector of types is T and they're at quantity Qi. This is exactly the increase in revenue that I get on that margin. And in an optimal auction, you're going to want to award quantity to those that have the higher marginal revenue, that bring the higher marginal revenue. Okay, but first the revenue equivalence theorem. In any equilibrium of any auction game in which the lowest type bidders receive an expected payoff of 0, which is very natural, the seller's expected revenue equals the expectation of the sum of marginal revenue integrating over all the quantity that's awarded to each of the winners. I just integrate marginal revenue and then sum over the bidders. Okay, so this theorem basically says that in fact, that formula here is exactly indeed marginal revenue, because when I integrate marginal revenue as one does to calculate total revenue, that's exactly what I get. Okay, so very simple. I needed type independence and quasi-linear utility. That's all I needed. Very nice. Very general. And so that, this shows the power of mechanism design, that we can make statements like this. In any auction game, this is the seller's revenues. It only depends upon the allocation of the good. It doesn't depend upon any transfers, because the transfers of money are all dictated by incentive compatibility. So you tell me how the good's allocated, I'll tell you how much revenue it's generated. So it's pretty amazing. And I just have to, remember this is marginal revenue, but that's also very intuitive. It's my marginal value minus something that's related to the rate at which I have to pay bribes to the particular bidder in order to keep them honest. So now let's talk about the optimal auction. An optimal auction, we're going to have to make some additional assumptions in order for things to be really easy. And many of these assumptions are pretty natural. So marginal revenue monotonicity. So the marginal revenue is increasing in type, weekly increasing in the other guy's type, weekly decreasing in quantity. Those aren't too bad. And then there's the regularity conditions. So these are basically the identical conditions we had for marginal value, but now we have them for marginal revenue. And they're strong. They're not as intuitive, because first, for example, this monotonicity, going back, that you can see, it's very natural for this thing to be monotone, marginal value. But once I subtract something from it, and it's this complicated thing that depends upon the inverse hazard rate and so on, then it's no longer quite as obvious that this should have the same monotonicity as marginal value. But in the easiest case, we will assume it. And then the final thing we need is the marginal revenue regularity, which is the same statement. I take two types of myself, TI prime and TI. And if it's the case that I have a higher marginal revenue than J, when I'm type T, I also have a higher, when I'm type TI, I have a higher marginal revenue than J when I'm type TI prime, which is bigger than TI. Okay, and that one, it really doesn't have much intuition anymore. Whereas the marginal value statement, it did have intuition, but so this may or may not hold, but when it does, then we get this nice result that suppose marginal revenue is monotone and regular, then the seller's revenue is maximized by awarding the good to those with the highest marginal revenues until the good is exhausted or marginal revenue becomes negative. So in the single unit case, we also had this regularity condition, and it was actually the same sort of thing that my value minus the inverse hazard rate was monotone. And when it wasn't, then I needed to use ironing in order to make sure that the probability of trade would be monotonic in type. And here we're going to get that monotonicity in type by making similar assumptions. And so really it is analogous to the single item case. And the form of the optimal auction is analogous to what we had with the single item. In the single item, this is exactly what I did in the optimal auction. I awarded the good to the guy that had the highest marginal revenue. Now with divisible good, marginal revenue is changing as I award quantity incrementally. And so I have to take that into account. So what I do is I look out, to all of you who I can award quantity to. I know, I imagine I know what the probability distribution is. So I know how I need to bribe you in order for you to be honest. And I basically look for who among you has the highest marginal revenue. And I start allocating quantity to you. As I allocate quantity to you, your marginal revenue falls by this monotonicity. And eventually I'll get to the point where somebody else has just as high a marginal revenue as you do, in which case I'll start allocating quantity to both of you. And I'll keep doing this until marginal revenue turns negative. At that point, I'll stop. And that's exactly what I did in the efficient auction. In the efficient auction, I award according to marginal value. As I award quantity, your marginal value falls. Eventually, I get to the point where there's a tie in marginal value, and then I start awarding to both those parties, and maybe a third comes in and so on. And I keep awarding quantity until I run out of the good or I bump into my marginal cost curve. If it's positive, but if my cost is zero, then I just keep going until marginal value turns negative, or I run out of the good. And usually I'll run out of the good first. But in this case, I'm doing the exact same thing in the optimal auction. I'm just allocating based upon that marginal revenue formula rather than the marginal value formula. I allocate to the guys with the highest marginal revenue and continue to do so until marginal revenue turns negative. And in this case, marginal revenue does turn negative. Whoops. Right, because it's marginal value minus this thing, this is all positive. This is positive, so I'm subtracting this positive thing, which is why marginal revenue is going to turn negative much sooner than marginal value, which is that's my incentive to withhold some of the good in the optimal auction. Okay, so that's revenue equivalence and optimal auction in a very general environment. Notice I didn't need to assume independent private values. I didn't need to assume symmetry. All I need to assume is independent types and quasi-linear utility, and then monotonicity and regularity of, first the marginal value function for revenue equivalence, and second, monotonicity and regularity of marginal revenue for the optimal auction. Okay, so we actually need some heavier lifting for the optimal auction, but quite frankly, as I said, that's okay because I'm generally going to want to be in this world here where all I'm exploiting is the revenue equivalence, and I'm going to be conducting an efficient auction. So, if that's one more reason why efficient auctions are really nice, we're maximizing gains from trade, that's great. And then secondly, an auction that's focused on efficiency or simplicity is going to be I'm going to have to make fewer assumptions to figure out what the auction rule should be. Whereas if I'm actually seeking to find the optimal revenue maximizing auction, then that's going to be a lot more work, and it's going to depend upon things like, I mean, notice that this marginal revenue function depends on lots of details, all the inverse hazard rates, and the exact form of your marginal value function, which I don't actually know. So this is really just a theoretical exercise, and but this is a very important theoretical result. But when we bring it to auction practice, we want to talk about robust mechanisms like uniform price auction and the like that we can actually implement without pretending that we have this base of common knowledge, the distributions from which all value types are drawn, and complete understanding of their marginal value functions. It's very rare for a bidder to understand well his marginal value function, let alone the market designer. So one thing about this optimal auction is it's inefficient, and it's inefficient now for two reasons. We're assigning the goods to the wrong parties, and we're assigning too little of the good. So we're assigning the wrong parties because the fact that you have a high marginal revenue doesn't mean you have a high marginal value. And I should be assigning good. For efficiency, I assign an order of marginal value, but there's no direct relationship between marginal value and marginal revenue. So high marginal revenue doesn't mean you have a high marginal value. And secondly, I'm going to be assigning too little of the good because marginal revenue is going to turn negative before marginal value does. And so I'm going to stop assigning too good. I'm going to withhold some of the good. And so we've actually looked at, well, what would be the best you could do if you weren't able to commit to preventing resale? So, one big problem with this is, fine, as a seller, I can withhold the good. But what's really hard for me to do is prevent the winners of the good from engaging in resale when I assign it inefficiently. So this one especially can be undone by the actions of the bidders after the auction. If I do something clever to improve revenues, then they can undo it. And if they anticipate that they're going to undo it, that's going to affect their bidding behavior, which is going to affect what I can accomplish. And so our paper basically says that if the resale market works very well, so if we look at the extreme case of perfect resale, which is probably, first order, it's probably a reasonable assumption. Certainly there's going to be inefficiencies in the resale market, but maybe they aren't going to be that great. Well, if the resale market is perfect, then it's a simple matter to show that it's pointless to attempt to misassign the goods. That's going to get undone, and when that's undone, you're going to lose the revenue gain that you'd hope to get by that misassignment. Okay, so that's just one more reason why this type of distortion you probably shouldn't get involved with as a market designer. And whoops. So what we show in the paper is that in this two-stage game, auction followed by perfect resale, the seller can do no better than the resale constrained optimal auction. And the resale constrained optimal auction is basically saying we will not engage in this. We will simply withhold some quantity of the good, but we will not misassign the good. And in fact, we can achieve that. So this theorem specifies that the seller can do no better than the resale constrained optimal auction. We can show how they can implement the resale constrained optimal auction with a Vickrey auction. So this is the Vickrey auction with reserve pricing. And it's that reserve pricing that's going to lead to some of the good being withheld. But there's no misassignment because we're going to implement Vickrey pricing in this context. And so this is very nice that we can implement Vickrey pricing in this very general world with divisible goods without independent private values, right? We've got independent types, but our values could be very much correlated. And the way we do it, it is just a natural extension of what we do in the regular Vickrey auction. So, first we assign the quantity efficiently. So we look at the values and we assign quantity to those that value it the most. And this is truth dominant. So actually it's not truth dominant, it's ex post equilibrium because of we have independent types, but there's possible correlation. And so but in any event, truth is an equilibrium in this. So you've got the correct incentives to bid your true value. From your true value, I can calculate the efficient allocation. So I determine the efficient allocation, but I consider the possibility of withholding some quantity. So the total quantity that I assign, I'm going to assign the quantity that I assign efficiently, but that quantity that I assign is going to depend upon the vector of types. And then there's going to be a payment, x star of t, that's a vector of payments to each, that's going to basically induce the truth being a equilibrium strategy. And it's it's similar, so this might look confusing, but intuitively what we're doing is the payment is integrating marginal value. So essentially you're paying marginal value, integrating over the quantity that you're allocated, but I'm evaluating your marginal value not at your actual report, TI, but at the lowest possible report you could have made and still won this quantity Y. And I do that for every incremental quantity from 0 up to the quantity that you got, QI star. Okay, so just think about what happens in a second price auction. One way to think about it is I am being charged my marginal value, which is my value for the good, but it's my value when I report the lowest possible type that would still enable me to win the good. Okay, so when I've got the highest value of 100, you've got the second highest at 90, that means I can report about a value or a type that's below 100, I can bring it all the way down to 90. And so that's what I'm charged, 90. So that's what this is doing. So it looks complicated, but it's doing exactly what we do in the second price auction. It's just the straightforward generalization. It took us a bit to get to this point, but it's it's very nice. And yeah, so that's the best we can do in instances where we can't prevent resale, which is typically the case. Resale is, can't be banned in, in most markets. So this is, a government can step in and ban resale. So the early European spectrum auctions, the governments typically banned resale, but we didn't in the United States. And now in the European markets, they allow resale, unless there's some sort of special circumstance. Okay, so this achieves the that upper bound in revenues. So now we're going to turn to applications in my last 20 minutes. And I'm going to say a few more words about electricity market design. I've talked about that quite a bit. I'm going to just say a couple words about climate policy because Axel's going to talk about climate policy later in the week. And so I'll just touch on that. I'll say a few words about spectrum auctions, almost nothing about mobile communications, a few words about transportation, and a few words about financial markets. But it's going to be very fast. So you should get, in 20 minutes, you'll just get an impression of what's going on. And like I said, in the sequel to this, we will go into each of these topics in greater length. Okay, so this is a system operator sitting in the control room, and it's using a lot of information and a lot of computer power. So this is Texas. Texas has 3,400 servers to do all their computation. So it's massively intensive in terms of computation. It's an extremely smart market. And the operators, what they do is they just look and in the old days, they would have to intervene a lot because the markets, the systems weren't as good. But now they almost always are just sitting there and doing nothing. They're sort of imagining scenarios that might happen and how they would react when they do, but they almost never do. The system just takes care of themselves. So it's really quite remarkable how it's getting more and more just perfect optimization, and the operators are just there in the event something really crazy happens, and all of a sudden you have to step in and get on the phone and that sort of thing. So the goal of the electricity markets is reliable electricity at least cost. That is achieved first through short run efficiency, making the best use of the existing resources, and then secondly, long run efficiency. Having a spot market that produces prices that induce the right investments. So we end up with the right resource structure at the end of the day. The key idea to make this work is open access, and lots of challenges. We have to balance supply and demand at every instant. We've got literally thousands of constraints that must be satisfied all the time, or the lines melt, machines break, really expensive, terrible things can happen. For the most part, demand response hasn't been very active. And so that's another challenge. And then every part of the world has a fairly chaotic climate policy that the investors in these markets are having to confront. The way the market works is the core foundation of the market is the spot market. I say the spot energy market. There's also reserves and other complementary products which are needed as well to have reliability in a world where there can be large shocks to either supply and demand. Then there's, so this is the day ahead in the real-time market. Then there's these medium-term markets where they're trading monthly electricity, or sometimes yearly, longer-term contracts, sometimes many years. And then there's long-term markets where they're trading many, many, many years of electricity. This combination of these forward markets together with a well-functioning spot market enable the market participants to address risk, the system operator to manage market power, and to establish prices that encourage efficient investment. So as I said, the market design has evolved over the last 2 decades. It's especially highly evolved in the United States and a few other countries, where we have a nodal market and we co-optimize energy and reserves on a day-ahead basis to establish the scheduling of units throughout the day. Then we rerun this throughout the day, make adjustments when stuff happens, and then we perform the real-time bid-based securities-constrained economic dispatch to establish the real-time price. But in terms of the financial settlement, it's basically dependent upon the day-ahead market, which establishes financial plans. So prices and quantities, these are plans. They're not binding commitment. You're locking in price and quantity at this point, but things can change. And then the second settlement is in real time. This problem right here is a large mixed integer programming problem that remarkably we can, even though it's a very hard problem, we can actually solve this. And fairly quickly on the latest computers with the latest algorithms. And then the real-time dispatch, that's a linear program. But the big output of these things are the prices, the day-ahead prices and the real-time prices. Because basically the generators and the demanders get to do whatever they want. And so they basically respond to the prices. So it's very important to get these prices right. And this optimization does just that. That's what it's designed for. And then of course, there's lots of forward trading, as I mentioned, to better manage risk and support the long-run investment. Here's a picture of, this is the load in the summertime in Texas. And this is also the day-ahead price in orange, with some blips there you can see, and the real-time price in blue. And you can see the real-time price is more volatile through this summer month, which is when things are most volatile, because that's when we reach our peak. And generally what you'll see is the day-ahead price and the real-time price will be on average about the same, but the real-time price will be more volatile. And so this is the motivation for the participants to do most of their trading either before day ahead or at day ahead. And the real-time market, although there's all the resources are participating in real time, and that's where physical dispatch occurs, there's very little volume that's actually trading at those prices. Nonetheless, most everyone is exposed to that price on the margin. And in the long run, everybody should be exposed to the real-time price on the margin. So they've got the right incentives to respond to these peaks. And that's what brings us reliability. And also it brings us the correct investment incentives. The markets have performed, the better markets have performed really well, even in the events. Like here towards the end of August, you see a very high day-ahead price and then a lower real-time price. And the reason for that is there was a massive hurricane, Hurricane Harvey, and Hurricane Harvey dropped 52 inches of rain that's it's almost 2 meters of rain in Houston over 5 days. And so with huge winds and is a big problem. So there was expectation that there could be trouble on this day or these days. But in fact, it didn't materialize. Things worked out pretty well, despite the fact that there were hundreds of miles of transmission lines that were down. There were lots of substations underwater. The system just kept sending out revising what the system looked like and sending out the right price signals to every node and inducing behavior so that the market just worked flawlessly through this whole chaotic event. And when looking at and evaluating how markets perform, it's very important to look at them when they're under stress. So looking at Texas during a hurricane, looking at Texas when it's 110 degrees Fahrenheit and 45 degrees Celsius, and there's no wind blowing. That's the time to look at Texas to see how it's performing. California worked for about 10 years perfectly fine when they had plenty of electricity. But when there was a very dry winter, and then they didn't have as much hydro as they normally have. And that's when we had the California energy crisis in 2000, 2001. So it's those moments and where the market broke down and its flaws were revealed. So you see the flaws when the market's under stress. Very important to look at those stress events. Climate policy, very quickly. So here's what Trump has to say on the matter. And I quickly I responded to his tweet. So he didn't respond back to me. So that was too bad. But the US, fortunately, we're going to have an election and there should be some change, I hope. And we will get back on track in solving global warming, which is very much a global problem and something that Axel and I and many others have written a lot about. There's a full book on this topic on my website, which is freely available, came out at MIT Press. And it's essentially this big cooperation problem. And so the question is, can we do something about it at an international level? And the answer is yes. And carbon price is the right instrument to do it. And the key is reciprocity. We need to basically implement sensible carbon pricing in, say, the United States and in Europe and in China, and use reciprocity. I will if you will. This is the insight of Elinor Ostrom. She won the Nobel Prize in 2009. So in a few words, climate policy is price carbon. I will if you will. That's the solution. And it's that easy. Axel will talk about it at much greater length than I had time to today. With respect to radio spectrum, this is a complicated economic problem. We got lots of items. There's some are substitutes, some are complements. There's competing technologies, business plans. The government objective, in my mind, is efficiency, make the best use of the scarce spectrum. We have to consider competition issues in the downstream market. So we, it might increase revenues if we auction off a monopoly communication system, but that wouldn't be good for consumers. We have to consider competition. So even efficiency is a complicated issue in this setting. We get to think about what product are we auctioning? How are we going to slice the spectrum in frequency, in geography, and how can we make the process work as best as it can? Over the last nearly 25 years that we've been doing these auctions, we've learned a lot. And so they've evolved to a very high state. There's also been large advances in technology, which has made equipment much more flexible. And that actually simplifies the problem that we have, because there's more substitution possibilities across bands, for example. And so it's becoming much more of a divisible good, which is a very good thing. The key is to enhance substitution by effective product design. And we now have a good handle on how to do that. We've also learned the importance of encouraging price discovery. So we needed a dynamic process in which the bidders can learn about both price and possible outcomes in order to better inform their valuation efforts. And that's going to actually improve efficiency. And then we attempt to do all this with a pricing rule and activity rule that encourage more truthful bidding. And I won't have time to say too much on this, simply that the main workhorse, the simultaneous ascending auction, has worked very well. And of course, that was the basis of the Nobel Prize last week, one component of it. But we've made lots of advances, and one of the, and certainly, you know, I'm making points about governments have had some screw ups, but overall they've worked very well, and they work a lot better when the participants are prepared, and the government does a good job in preparing as well. These are some examples where they didn't do such a good job. Germany had one spectrum auction in 99 where they were auctioning 10 blocks simultaneously, and it looked actually very much like the exercise that we performed earlier in the class. The auction ends, so we've got 10 blocks. The bidders bid for each of the 10 blocks separately. They're identical items. The auction ends when no bidder is willing to bid any higher. So what actually happened? So in the very first round of bidding, this is basically the minimum bid, the reserve price, and there was a rule that you had to bid 10% more in order to top the next bid. So there was a bid increment of 10%. And so management, what they did was they put the minimum bid on 5 units and then bid 10% more on 5 units. And what that did was it sent, little noise right there. Not sure what that was about, but probably just that they were emphasizing sort of exactly how clever they were, and that they were in fact happy to throw away $16 million just to demonstrate how clever they were. So why this is so clever is there are 2 bidders, management and telecom, and T-Mobile. And telecom basically sees that they're bidding simultaneously, and telecom bid just the minimum on, and I think they bid the minimum on, I don't know how many they bid for, but this is what we see, because this is just over the slightly a penny over the minimum, and then they bid the 10% more on these 5. But what this is a very clear signal that management should win these 5, and telecom should win these 5. And so in the second round of bidding, look what we have. Telecom comes back with 40 and 0, no bids for the others. And then in the third round, we're done. Okay, nobody bids any higher. So everybody got 5 for 10% more than the minimum. And these are things that are worth hundreds of millions of dollars, and they're paying 40 million. So that's a good example of cooperation, and they were basically able to signal the demand reduction And that was very effective. And it's and quite frankly, Germany still, it was aided by the fact that they have full transparency of the bids. So everybody could see this, who is bidding what. And despite this happening in 1999, Germany has persisted with these rules, full transparency, sort of very old school. This is the way spectrum auctions were done in 1994 in the United States. And Germany has not moved 1 inch from that. This is the way they always do it. And they've been very fortunate that some of their auctions have been incredibly competitive, that the cooperation has failed, but they're definitely exposed to potentially very inefficient and very low revenue outcomes, such as this. So my hope is that they will improve. As you can see, there's lots of work to do yet in market design. And I'm not going to have time to talk about the combinatorial clock auction, which is one innovation. But right now, because of the flexibility of resources, a lot of the reasons for having the combinatorial clock design was to let people bid on packages to avoid the exposure problem of winning part of what you need when there's very strong complementarities. Well, those complementarities have turned out to be less important in the last couple years because we're auctioning incremental spectrum for very flexible resources. So we're really stepping into a situation that's much more simple. And the guys are just putting together desirable portfolios of spectrum that the amazing handsets can handle and their software-defined radios in their cells. And so in fact, typically we don't need the full power of this combinatorial clock auction, but it's there in instances when we do, when the complementarities are very strong, there's lots of lumpiness, and that's, but most of the time now, we don't have that. And so we can have we're going to have simpler simultaneous clock auctions, which manage information in a proper way, just revealing excess demand as opposed to the individual bids. And that performs extremely well. Well, I'm actually going to jump to the end. Let's see if I go here. That's the very beginning. We don't want to jump there. But we've run out of time. So I'm not going to cover the other topics. You'll have to take the sequel course. But I wanted to conclude with this slide, which is basically when we look at the applications, there's lots of important applications out there. And most of them, in fact, let me say all of them, have lots of important work that has to take place. I've got these green check boxes for electricity, but in fact, electricity is changing very quickly with the introduction of, with the energy transition to renewables. And the market designs have to evolve very quickly at a pace they've never had to move before in order to keep up with the technological innovation. So this is a very exciting space. The same thing is true with communications. We can do so much more than what we have today. Transportation, we haven't scratched the surface. We don't price congestion, we should. Climate, we don't price carbon, we should. These things are non-trivial to implement. And lots of good market design has to take place. And then financial securities was the last thing I was going to talk about. And the reality is there's huge advances that need to take place and can take place. And I'm not sure whether they will actually happen in my lifetime, but because basically what we've got now works sort of okay. But certainly there's scope for lots of innovations here that are also fairly straightforward to think about and study, but are difficult to implement because of the tyranny of the status quo. So plenty of work ahead, and I hope that all of you will think about doing research in the market design area, or think about practice in the market design area. There's certainly scope for both research and practice. And that's the beauty of market design, is the theory is intimately linked with the practice. So for me, that makes it a lot of fun and very satisfying. So I thank you. Sorry that we had to work virtually this semester. I will be back on campus in 2021. I don't know whether that will be in the spring, which I hope, or the fall, but I will be there. And at least by the fall, and look forward to meeting you in person then. So until that point, I will say goodbye. Thank you very much. And I hope you enjoy the rest of the economic engineering class. Thank you.